is much lower on a HomeStyle renovation loan compared to a 203K. So if you have buyers that have very good credit and their income is good, when they wanted a renovation loan, let's say 5 years ago, they had to utilize the 203K. Fannie Mae, this is their answer to that on a conventional loan basis. Eligible properties, 1 to 4 unit primary residence, 1 unit second homes, and investment for single home condominiums and PUD. So an investor can utilize the HomeStyle renovation loan, and they would have to put as little as 15% into the deal. Okay, so if they are going to buy a property and the house is worth $300,000 and it needs $100,000 worth of work, it's $400,000 with $60,000 of their money into the deal, they could finance as an investor with as little as 15% down. And if they already own the property and they'd like to fix it up and sell it because, let's say they had to close cash because it was a foreclosure or something, they had to close fast, then we could do it as a refinance with 25% into the deal, which typically we can use the equity, obviously, that they would already have in the property to finance that. Very good change that's happened, obviously, over the last year or so. Fannie Mae has also introduced the Home Ready program, which is a first-time homebuyer program, which also is Fannie Mae's answer to a standard FHA mortgage, right? So standard FHA mortgage, same thing, allows people to put 3.5% down. Fannie Mae's Home Ready program allows you to put as little as 3% down. Same thing there, no upfront mortgage insurance. If you have better credit, the mortgage insurance is going to be less, the APR is going to be less. So you can utilize the Home Ready program along with the HomeStyle renovation program. So if you're a first-time home buyer, you can get this HomeStyle renovation loan with as little as 3% down. There are income restrictions. It is specific to the property address. So if you have anybody that might fit that, then have one of our representative, Vince, can look up the address for you and let you know that it qualifies for home ready financing. 85% for a 2-unit primary, 75% to a 3 to 4 unit primary, 90% for 1 unit second home. The key to the HomeStyle renovation loan is that the renovation cannot exceed 50% of that after appraised value. Okay, so obviously we do the calculations ourselves. This, not to bore you too much with it, but there are things that, like the 203K, can be financed into the loan. We do these worksheets. They're pretty straightforward from our side, but we come up with a loan amount that the borrower is eligible for, and we calculate the mortgage and things like the mortgage insurance based off of these worksheets that we do. Yes, please.
The rental cannot exceed 50% of after appraised value in part by ignorance. So, could you give me an example? Like
sure.
If they buy it for 100, yep, and they want to put 50 into it, and then afterwards it's devalued. Those some numbers.
Great question. So we look at the property 2 ways, okay? And it's a very good question. So we look at the property as is valued, and then the contractor, based on the scope of work that's going to be done, like you said, that $50,000, we're going to come up with an after appraised value. Okay, so let's use that example you gave. I'm buying the property for 100. It needs $50,000 worth of work. Let's say the home is going to be worth $200,000 when the work is done. So the renovation could not exceed $100,000 in that example. Okay, because the after appraised value is going to be 200. The renovation could not exceed 100,000. So if it's 50,000, it's fine.
Okay, but if it's 175, then the renovation couldn't.
It's still fine. So the only thing is, if you're buying the house for 100 and it needs 50,000 of work, the after appraised value would have to be obviously for less. It really only matters if there's larger scale renovation program, larger scale renovation type deals that you're trying to do. So, for example, let's say you're buying a house for 100 and it needs 200 plus worth of work, and then it's going to be worth 400. Now I'm exceeding that 50% ratio. Okay, so just keep that in mind. Any other questions on the HomeStyle renovation loan? 203K, like I said, this program has been around for a very, very long time. I personally, did my first 203K back 20 years ago. It is an FHA loan. Allows the option of buying or selling a property in any condition. The fixer-upper loan, as it's also known as, includes rehabilitation costs into the mortgage, refinancing options as well for existing homeowners. The total value of your home is projected after the renovation is complete. A portion of the loan is used to pay for the purchase of the home, and the other portion is put into an interest-bearing account for the rehabilitation as the rehabilitation stages are completed. You can finance up to 110% of the after appraised value in our calculations. Some rehab costs are financeable, like the architect, the HUD inspector, the permits, and the other inspections that are done on the property. So, you know, it's hard when an appraiser is looking at a property as is and then basing the value on the work that's going to be done. So HUD gives that, you know, 10, 13% technically range leeway to figure out what the property, the financeable amount of the loan is.
So could you go back? I'm sorry.
Sure.
Which is why I'm here.
Don't be sorry. This cooperates.
So how is, when it comes time for the purchase, how is this loan different than the Fannie Mae HomeStyle? So you're going, you know.
Good question. So the
I mean, in terms of the money that the $50,000 or whatever that's needed for the work, is that?
It works similarly. They're very similar in how they work.
Okay.
You know, again, because it's an FHA loan, it does. FHA allows for lower credit scores than Fannie Mae, allows for higher debt-to-income ratios than Fannie Mae. So you get the advantages of the FHA criteria in the 203K, where Fannie Mae guidelines tend to be a little bit more restrictive for borrowers in qualifying. Also, on a conventional mortgage, for example, if you do have a lower credit score, because you're going to the private insurance market, your mortgage insurance premiums are higher when you have lower credit scores. Where the FHA, which obviously it falls under HUD, the best way to think about the FHA is exactly that. They're just a big insurance company, right? So they insure these mortgages. And so it's not credit score driven, since it's a government agency and they want to make credit available to more homeowners. Of course, you know, I always say it is a privilege to own a home in this country, but your insurance premiums are not affected by your credit score. If you're going for max financing, regardless of your credit score, the annualized premium is 0.85% of the loan amount. That's what you pay over each month in your payment. If you're putting 5% down or more, it drops to 0.80. And then if you're going into that high balance area where the loan amounts are going up to the 679, 650 now, those premiums may go a little bit higher, but it's not driven by credit score. So that's a major advantage. Basic property requirements, $5,000 minimum in repair. And just a quick note on that, if it's not a health and safety issue, we can do an escrow holdback as an FHA lender. So if you do have a property that has like minor things that need to be done and the seller is not willing to do it, but the buyer is willing to do it after closing, we can do those smaller things without having to utilize the 203K. Okay? But if it's something structural, it does have to be addressed. And then the maximum repair, so like where the HomeStyle, you have that 50% rule, with the 203K you do not. So if you want to buy a house at $100,000 and it needs $250,000 worth of work and it's going to be worth $400,000 after, you can do that under the 203K. Okay, you can do it up to the maximum loan limits. And in Monmouth and Ocean counties, that maximum loan limit is that $679,000, $650,000. Okay. Eligible improvements: kitchens, baths, exterior decks, patios, porches, HVAC, anything structural, anything cosmetic as well, as long as the value is there. Again, the appraiser is going to determine that. Okay, based on the scope of work, there is a HUD inspector also involved. So what we always recommend is that the contractor and the HUD inspector go to the property together with you and the buyer, because what happens? The buyer is going to take the contractor there and says, I want to do this, this, and that, right? But the HUD inspector has to tell them what is mandated by the guidelines for them to do. So if the inspector goes a different day than the contractor, what ends up happening, and from experience I can tell you, is the contractor writes up their scope of work, and then the inspector says we have to do this other stuff, and we get into this back and forth. The best thing is for them to be there together. Okay, so they're on the same page, they walk through the property together, and so when the contractor does his write-up, it matches the other items that the inspector does, because the inspector will do his own or her own independent write-up as well. That saves so much time, believe me. Here's the differences between the three loans, okay? HomeStyle, and again, Monmouth and Ocean, same thing, the loan limits are the same, all types of renovations. All of these programs require to be done on the existing foundation. So you can knock down a property, leave up one wall, right, as we all know, on the existing foundation, and that's considered a renovation, okay? So you can utilize these programs in that case. Inspector may be required in HomeStyle, not always required. It depends on, again, the scope of work that's going to be done. And it does allow for luxury items like a pool or an outdoor kitchen, where the 203Ks will not. Standard 203K structural renovations requires, again, same thing. The existing foundation requires the HUD inspection report, and we can also finance up to 6 months of mortgage payments. So if the house is really going to be one of those knockdowns where you're just leaving up one wall and you're going to have to live with family or rent a place in the meantime, we can finance 6 months of the mortgage.
Do you have a handout this or something?
Yeah, we're going to share this whole presentation. We'll send it out to everyone so you have it.
Absolutely. Too much to
and feel free to
information.
Yeah, absolutely. Yeah. We'll be glad to send it out.
Okay, great.
So there also is a streamlined 203K. This is a great program, and the HomeStyle works the same way. If the person does just want to do the bathrooms and the kitchens and the tiling and change the carpeting and the windows, anything that's non-structural related, then the HUD inspector is not required. They can go, they can go to Home Depot or Lowe's and price out the job, submit that to us, and it's a great option. So it's a lot easier process because the inspector is not involved. So we've done quite a bit of those. Again, same thing here with the 203K also, which is very good, is the architect, the consultant, the inspection fees, the title update fees, and the permits. Title update fees is if there's a number of draws. Every time a draw is done, the title has to be updated to represent that draw and increase the loan amount. All of those fees we can factor into our financing. Okay, so the borrower doesn't have to lay that money out of pocket. As long as that after appraised value can sustain these numbers, it's really a great option. They will pay the inspector up front, but at close, with the first draw, they will get that money back. Okay, so it really is a great program for that. Contingency reserve, depending on the amount, the dollar amount of the project, a contingency between 10 and as high as typically 15% is going to be required, and that's for, as we all know, if you've ever done any work to your house, you decide to do this, and then you open the wall, and you have to do that, or you rip up the carpet, and you need additional money that you didn't otherwise plan for. The contingency is there to help make sure that you have the funds available to take care of that stuff. And again, we figure out, based on the as-is property value, the adjusted property value, and the after-improved value, what the loan amount is that we can give, okay? And the main thing here is that of that total cost, to use your example from before, 100,000 worth of work, I'm sorry, 100,000 purchase price, 50,000 worth of work, your total project being 150,000, you only have to put as little as 3.5% down. And we're going to finance in a lot of those additional services that you would otherwise have to pay out of pocket. construction loans. This is exciting because it's newer and it's a one-time close. It allows up for a 12-month construction period. And this is where we're talking if you have somebody that's interested in buying land and building a home, okay? And in Monmouth and Ocean County, we have this product available up to $679,750 loan amount. Okay, so you can do that tear down. It does allow for modular homes as well. And as long as the borrower has a 720 credit score, we can finance up to 90% of that total project cost up to the $679,750. So I'm excited to see this product come back because why? Right? That's all we hear in the news. You hear it, I'm sure, from Realtor.com and the brokerage as well. Inventory is where? 1991 levels, right? And yet there's more buyers in the market today than there has been since 1999. So it's a bad combination, I guess, if you're looking to buy a home. And this money hasn't been available to people. Typically, if you go to the local bank, which they've done a great job, local banks and community banks, in the meantime, stepping in. But if you want to build a home from scratch, you're typically looking at having to put 25% of that total project out of pocket. So this allows for a lot more people to have access to construction money. Okay? Any questions?
Would you mind go back to the page?
Sure.
I'd like to. Thank you.
Sure.
So you're saying you can do 10% down?
Up to 10%, yeah, as little as 10% down. Please.
How is the amount that they're for additional improvements that they're approved for determined?
So a good question. We're gonna qualify them on that total amount. So when you're first talking to people, and obviously, we rely on you as the realtor to give, an indication of what may need to be done and a ballpark figure, and the buyer as well. So that's typically what we're looking at. So you're buying a house for $200. You say, Vin, this house may need, 50, 60,000 worth of work. We're going to take that 260 number, see what the borrower can put as a down payment, and then qualify them on that.
Is there any decent way to ballpark that? Not something I would tell a client, but I could have in my head before they you guys run it?
Yeah, I mean, the main thing is to understand, how much work the property may need. I mean, the qualifying aspect is the same way. So if you're going to show them those type of properties, I recommend us pre-approving them before they even go and look at it. That's always the best thing to do, but sometimes they want to see the property first, and that's fine. And maybe say, look, if this property needs work, I will be glad to show it with you, but do you have a contractor you can bring along when we look at the property to get really a good idea of how much money you're going to need to fix this property? Then let us know, and then we can qualify them off that number. I mean, conventional mortgages, Fannie Mae has loosened a bit. They do allow, for example, up to 50% debt to income, where they were at 45%. FHA allows you to go over 50, they allow you to go to, almost 57% with compensating factors. Of course, we don't want people to, be in the 50% of their gross monthly income as a mortgage payment, because obviously your gross income isn't what you take home. But if they're putting 10% down, and for example, like all of you being Schedule C self-employed people, you write off a lot of your income, if we can see that you have good credit and it's just really a function of how you file your tax return, then we can stretch those ratios a bit. But if you're, a wage earner, in my opinion, you really want to stay, under that 50% debt to income. So we're really gonna, the first option is always the conventional option. That's the reality of it because it carries lower APR. It's a better mortgage for the consumer. But again, FHA has, been around a very, very long time and serves a very good segment of consumers, and the default rates on government loans have been, much lower through the years. So it does serve a purpose. But getting an idea of the amount of work really is the most important thing for us. Yeah. Okay.
Do construction loans cover fees like the architect's fee?
Yes, they do. We can finance a lot of that into the loan. As long as that after appraised value is there, you know, that's where we're going to determine the final loan amount, then we can finance some of those costs into it. And with the new construction, the construction period is interest-only payments on the new construction. Because you understand, again, you're going to have to live somewhere else while you have this mortgage. Any other questions?
Do you do that with 2 or 3K? Like if somebody's renting an apartment but the house needs to be worked on?
On a full K, we can do up to 6 months finance payments
Oh, okay.
into the loan. So you wouldn't have to make a payment. It's technically works out to be 7 months, right? Because your first, let's say you're closing in January, your first mortgage payment is until March anyway. So you'll get the first 6 payments in the loan. So you'd have 7 months of not worrying about the payment. Now, if they have to rent and can't live with family, we do have to qualify them with that rent payment. You know, so they do have to qualify carrying the rent, if that's going to be the case. Any other questions? Well, thank you for your time today. Really appreciate it. I'll have Vince send this presentation out so you have it. Any questions? We work as a team and is very familiar with these programs as well. And any scenarios we review together. So you may not see me, but I'm here. Okay. Thanks.
Okay.
Thanks so much.
Thank you.
My pleasure.